Marvin Barth, founder of Thematic Markets and former head of FX over at Barclays, joining us now. Nice to see you. It's been a while.
Nice to see you. Pleasure to be back.
The dollar is back as well.
Yes.
In a big way. And you think actually this cycle is going to be much bigger than all of us currently think. Maybe not you, but most of us think right now.
Yeah. No, I've done some really interesting research looking at what drives these big dollar cycles, and it turns out it's innovation cycles that seem to center out of the United States. The interesting thing is this one is very different from the ones in the past, in part because of the much shorter investment cycles here and the rapid pace at which innovation is taking place, so it's extending much further. And if you look, the capital expenditure boom behind it is much more extended than it's been in the past, and it's also much more American-centric.
Okay, so does that mean that interest rate differentials, we're looking at the CPI print today and what that ultimately is going to mean for the Fed in terms of its rate trajectory, in terms of trade, a lot of people are looking at the terms of trade story here in Europe and thinking that could be one of the big reasons why the euro is down as aggressively as it is. Japan, similar problem. To what extent did those stories play in as well, particularly on a day when we're watching a very strong CPI print coming through?
Well, so certainly some of those other stories, you know, Japan's monetary policy, clearly in the yen case. In Europe, it is definitely a terms of trade story as well. But the interest rate story itself is exactly what I'm talking about. What's driving up interest rates in the U.S. relative to the rest of the world? What's driving all that demand that's creating the inflation that people were not expecting? It is this massive investment boom, this localization drive to bring everything back to the United States and automate it that's driving it.
So, Marvin, it sounds like then the sky's the limit, in essence, for the dollar. What breaks then?
Well, ultimately, these things tend to shift to other currencies when you see that technology pass on to the rest of the world. There's two big things that are very different about this cycle, Alex, from the past ones. One is, as I mentioned before, you have that the cycle is much shorter in terms of the technology build and new innovation taking place, and that's still all coming out of the U.S. for the most part. So it's harder for the rest of the world to catch up. The second is that this is about localization. It's about bringing things back to produce in the U.S. It's undermining the whole globalization trade that was building up the rest of the world. That's really a problem for many of the rest of the world's economies, and it continues to support the dollar.
So inflation stays with us for longer as well. That's the net result of that.
But of course, that ultimately is something the Fed is going to have to address, right? And that will help support the dollar as well.
The rates go up and they stay up.
Yes. And I think the U.S. economy handles it better than people think.
Okay, so what does that look like then? Within, like, what are we looking at in the FX market for that?
So, look, I don't want to call a specific top here. I don't see the end of this anytime soon. I've been consistently against the market in calling for dollar strength when most other people have been bearish since about 2018. I made a call back then that this cycle would look very different from all the rest. It would be much longer, much higher plateau than the past. I don't see the end of that yet, Alex. So I can't tell you where the top is or exactly when it is, but I can tell you I can't see it from here.
Wow, okay.
That's
so we're still some way
huge.
away. Where does that leave the Bank of England? Where does that leave the ECB?
So this is a real problem. It's not just for them, it's for central banks all around the world. Now, I actually think the Bank of England is in a somewhat better position. This country, as much as people like to dump on it, actually is a technology producer, right? You think about the Cambridge-London corridor and all the tech that's taking place there. It's a leader in AI. It's a leader in aerospace. A lot of that stuff is taking place here. When you go to Europe, remember, they were much more levered to the globalization trade that's breaking down, and they're facing a much more severe terms of trade shock from Europe. So I think it's the ECB that faces the greater pressure here, and also a lot of those emerging markets that were so levered to the globalization trade.
I know you're not going to give specific levels, but I'm just wondering what this does to the euro, which is, okay, so if you're going to make sort of a more bullish or constructive case for the UK, what about Europe?
Yeah, I think we're still on the way down in euro dollar. I don't think that we should discount the low 90s by the end of this year. We've had a little bit of a dead cat dead cat bounce recently on the ECB's hike last week, as well as the gains in Ukraine. The war in Ukraine is far from over, and it's not going to turn around quickly enough for Europe. We're going to see sustained pressure on Europe from all of this.
In the past, we've seen emerging market crises cause the Fed to rethink policy. Russia, there's plenty of examples. Will that happen again? Is there a feedback loop from what is happening in the United States back into the Fed that forces it ultimately to curtail policy earlier because the rest of the world simply can't handle what is happening here?
You know, this goes back to Secretary Connolly's old remark.
Yep.
It may be our dollar, but it's your problem.
Yep.
In many ways, that's the way the Fed looks at it. I think people have confused a lot of the instances where the Fed has reacted to things going on in emerging markets. When I started my career at the Federal Reserve, I was the desk officer for Southeast Asia during the Asian financial crisis. We were focused on that then because we were worried about the blowback in terms of the amount of trade we did with it and how much it was going to slow the U.S. economy. If the U.S. economy is still going gangbusters because of this localization trend, it's your problem.
Marvin, before we let you go, if I'm going to look at the short-term direction of the euro, am I just going to be looking at Netherlands gas prices?
That's a good one, although, you know, they've built this new LNG facility much more rapidly than anyone expected. So there is some positive news around that, Alex.
So does that mean that you actually see some short-term stabilization in energy prices and then like the opportunity for the euro to gain some stability here?
I could see that the euro could follow through in the short term with this dead cat bounce, with what's been going on in Ukraine, but ultimately, I don't think that lasts. I would expect in the next 2 to 3 weeks, you'll start to see the downtrend reemerge.
I'm still thinking you're looking at TTFF. All right, Marvin, thanks a lot, Marvin Barth. Thematic Markets founder.